The trader you become. Random entries. An entry is not a trade plan. The market starts moving. A large candle appears. Momentum begins to build. And the trader thinks, "That looks good." Click. The position is open. Only then does the trader begin asking questions. Where should the stop go? How much risk is acceptable? Where is the target? Should the trade be held? Should the stop be moved? Is this a scalp? Or is this supposed to become a larger trade? The trader entered the market. But perhaps the trader never actually planned the trade. There was an entry. There was risk. There was money on the line. But there was no complete decision process before the position was opened. And this may be one of the hidden problems behind many random trades. Because an entry is not a trade plan. Chapter 1. It looked good. Random trades don't always look random. That's what makes them difficult to recognize. The trader doesn't usually think, "I'm going to take a completely random trade now." The trade often looks reasonable. The market is moving. Momentum is building. A level is breaking. A candle looks strong. The trader sees something, and in that moment, the trade looks good, or perhaps good enough, so the trader enters. But there is an important difference between seeing something interesting on a chart and identifying a qualified setup. It looks good as an impression. A setup is defined. An impression creates interest. A setup creates a process. And when those two things become confused, a trader can enter the market before the most important decisions have been made. The trader may even be right about direction. The market may continue exactly as expected, but being right about direction does not mean the trade was planned well. A trader can correctly predict the market and still execute a poor trade. Because seeing an opportunity is only the beginning of the decision process. It is not the end. Chapter 2. Traders take random entries for different reasons. There is no single reason every trader takes random trades. For one trader, it may be fear of missing out. If I don't enter now, I'm going to miss the move. For another, it may be revenge after a loss. I need to make that money back. For another, it may be excitement after a profitable trade. I'm trading well today. There may be more. Sometimes, the trader is bored. Sometimes, the trader wants to feel productive. Sometimes, the market is moving quickly, and the speed of the market creates urgency. Sometimes, the trade simply looks good enough. The psychological reason can be different, but something similar often happens next. The trader enters before the trade has actually been planned. The emotion may be different. The thought may be different. The story may be different. But the process quietly becomes incomplete. And once the trader enters an incomplete trade, every decision that wasn't made before the entry still has to be made only now. Money is at risk. Chapter 3. The decisions that were never made. Before a planned trade, a trader may know exactly what they're looking for. The setup is identified. The entry location is defined. The stop loss has a reason. The risk is understood. The target is identified. The management method has already been considered. Then the trader enters. The position may still create emotion. The market may still behave unexpectedly. But many of the most important decisions have already been made. A random entry is different. The trader enters first, then begins planning. Where should the stop go? Perhaps here, but that feels like too much money. Maybe a little closer. The market moves against the position. Now the trader wonders, should the stop be moved? The market turns around. Now, Where is the target? Should profit be taken? Should the trader hold? The position moves quickly. Now, how should the trade be managed? Every unanswered question becomes a live decision. And every live decision is now being made while the trader is exposed to risk. That's an important difference. Before entry, a stop loss is a point of invalidation. After entry, the stop loss may feel like money about to be lost. Before entry, risk is something the trader can evaluate. After entry, risk may become discomfort. Before entry, a target can be identified from the market. After entry, the question can quietly become, how much can I make? Before entry, a management method can be selected based on the type of move. After entry, the trader may begin asking, how do I keep this profit from disappearing? The decisions are technically the same, but psychologically, they no longer feel the same because now, the trader has something to lose. Chapter 4. An entry creates pressure. This is why random entries can become so emotionally difficult. The problem isn't only that the setup may be lower quality. The entry itself creates pressure. Once money is at risk, the trader wants answers immediately. Where is my stop? Where is my target? Should my position be held? Should I get out? But those answers may not exist yet, because the trader skipped the part of the process where those decisions were supposed to be made. The position is open. The P and L is moving. The candles are changing. And the trader is trying to build a plan inside the trade. Perhaps that's why random trades can feel confusing. Perhaps that's why the trader becomes jittery. Perhaps that's why stops are moved. Perhaps that's why profits are taken inconsistently. The trader isn't only managing the market. The trader is still trying to decide what the trade is. And that creates an important question. Before the next entry, perhaps the trader shouldn't only ask, does this look good? Perhaps the trader should ask, have I actually planned this trade? Chapter 5. Every trade must independently earn execution. A trader may begin the day extremely prepared. The market has been analyzed. The setup is identified. The entry is planned. The stop is defined. The risk is accepted. The target is clear. The management method has been considered. The trader waits. The setup appears. The trade is taken. And eventually, the trade ends. Perhaps it was profitable. Perhaps the stop was hit. Perhaps the trade simply didn't develop as expected. But now, something important happens. The trader is still sitting in front of the market. The charts are still moving. New candles are forming. New opportunities seem to be appearing. And the trader begins looking for the next trade. This is where the quality of the decision process can quietly begin to change. The first trade was planned. The second trade looks like continuation. The next trade looks interesting. Another trade looks good enough. The trader may still believe the same process is being followed, but perhaps something has changed. The preparation that existed before trade 1 is no longer present before trade 2. And this leads to an important principle. Every trade must independently earn execution. Trade 2 does not inherit permission from trade 1. A profitable first trade does not authorize another trade. A losing first trade does not create the need for another trade. The market continuing to move does not automatically create another trade. Even being inside the trading window does not mean another position must be opened. Every trade begins at 0. A qualified setup must still exist. The entry location must still make sense. The stop must still be defined. The risk must still be accepted. The target must still be identified. The management method must still be considered. Whether it is the first trade, the second, or the fifth. The trade must independently earn execution. Chapter 6. The pause between trades. Many traders understand the importance of pausing before an emotional decision. But perhaps there is another pause that matters just as much, the pause between trades. A trade closes, and almost immediately, the trader sees another move. It looks like continuation. The market is still strong. Maybe there's another opportunity. Or after a loss, it's turning back around. The original analysis was right. I can make it back. The trader enters again. Technically, this is a new position. But psychologically, the previous trade may still be continuing. The excitement may still be there. The frustration may still be there. The urgency may still be there. The desire for relief may still be there. The position ended. But the trader never reset. And without a reset, the next trade may inherit the emotional state of the previous one. This is why the pause matters. The pause creates a boundary. Trade 1, complete. Hands off. Step away, reset, return. Then ask a completely new question. Not, what should I trade next? But, is there actually another trade? Those questions sound similar, but they lead to completely different decisions. What should I trade next? Already assumes another trade should happen. Is there actually another trade? Allows the answer to be no. And sometimes, no is the professional decision. Chapter 7. A new position requires a new decision maker. A trader may believe that every new order is a new trade, but perhaps that's not always true. Imagine a trader takes a loss. The stop is hit. The trader immediately sees the market turn. Another position is opened. That position loses. The trader enters again. Then again. By the end of the session, 5 trades have been taken. But were there really 5 independent decisions? Or was there one emotional decision sequence, containing 5 different orders? That's an important distinction, because a new position does not automatically mean the trader returned to a calm, decision-making state. The previous trade may still be influencing the next one. A loss may create urgency. A win may create confidence. A missed move may create fear of missing out. A fast trade may leave the trader overstimulated. The market's momentum may quietly become the trader's momentum, and the next decision becomes faster. Then the next, then the next. Professional traders learn to separate fast execution from fast decision-making. Sometimes a trading plan requires immediate execution, but that doesn't mean the next decision should also be rushed. The market may be fast. The decision process can still be deliberate. A new trade deserves a fresh decision maker, one who has returned to the process, one who can identify the setup, one who can define the risk, one who is no longer trying to finish the emotional story of the previous trade. Perhaps every trader should ask before entering again, if the previous trade had never happened, would this trade still be planned? If the previous loss had never happened, would the setup still qualify? If the previous win had never happened, would the trader still want this position? If the previous move had not been missed, would this entry still look attractive? If trade 1 had never happened, would trade 2 independently earn execution? That question can reveal a lot. Chapter 8. Trade 2 does not automatically follow Trade 1. Many traders create rules like maximum 2 trades per day or 1 to 3 trades per session. Those boundaries can be useful, but sometimes the mind interprets them differently. The trader takes one trade, then thinks, I still have another trade. The maximum quietly becomes a target. Permission quietly becomes expectation. And the trader begins looking for a second trade simply because a second trade is allowed. But a trade limit is not a trade quota. A maximum of 2 trades does not mean the trader needs to find 2 trades. One qualified trade may be the entire trading day. No qualified trades may be the entire trading day. And for some traders, 5 independently qualified trades may fit their tested system. The number itself isn't the lesson. The quality of the decision process is. The number of trades should come from the system, not from boredom, not from frustration, not from excitement, not from the need to feel productive, and not from the belief that an unused trade opportunity must somehow be filled. Trade 2 does not automatically follow Trade 1. Trade 2 has to earn its way through the process again. Pause. Reset. Identify the setup. Define the entry. Place the stop. Accept the risk. Identify the target. Choose the management method. Then, and only then, does another trade exist. Before that, there may only be a desire to enter. Chapter 9. Finishing is part of the process. Traders spend enormous amounts of time learning how to enter. They study setups, timing, confirmation, market structure, but perhaps there is another skill that receives far less attention. Finishing. A trader takes a good trade. The trade reaches the target. The position closes. And almost immediately, the mind says, "What else?" The trade may have lasted 30 minutes, 10 minutes, or even 1 minute, but the duration of the trade does not determine whether the trader's job was completed. The trader may have waited for hours, prepared before the session, identified the opportunity, accepted the risk, executed correctly, managed the trade, reached the target. The market simply delivered the move quickly. A short trade is not an incomplete trading day. One well-executed trade can be enough, not because every trader should only take 1 trade, but because a trader should not confuse more activity with better trading, especially while learning discipline, building a process, or trying to make good execution more automatic. There may be enormous value in focusing on complete decisions. 1 complete trade, 1 fully planned process, 1 opportunity executed from beginning to end. Because it is much easier to study 1 complete decision than 10 random ones the trader can barely remember. Finishing a trade is part of trading. Closing the decision cycle is part of the process. And once the trade is complete, the default does not have to be find another trade. The default can simply be done. If another high-quality setup appears later, the process can begin again, but it begins again from the beginning, not from the emotion of the trade that came before it. Chapter 10. What makes a trade a trade? If an entry is not a trade plan, then what is? Perhaps before a trader opens a position, several important decisions should already exist. A qualified setup, an entry location, a stop loss, accepted risk, a target, a management method. The exact details may be different for every trading system, but the principle is the same. The trader should understand what is being traded before money is placed at risk. Start with the setup. What exactly is the trader waiting for? Not, "The market looks strong." Not, "This could keep going." Not, "That candle looks good." What is the actual setup? What conditions make this opportunity part of the trader's process? A qualified setup gives the trade an identity. Without it, the trader may simply be reacting to movement. Then comes the entry location. Why here? Why this price? Why this moment? Is the trader entering at the beginning of an opportunity or chasing after the market has already moved? A good idea entered at the wrong location can still become a difficult trade. Then comes the stop. Where is the trade wrong? Not how much money does the trader want to lose, but what market condition invalidates the idea? The stop should have a reason before the position is opened. Because after entry, the stop no longer feels like a technical decision. It begins to feel like money. Then comes risk. Can the trader genuinely accept the loss if the stop is hit? This question matters because placing a stop and accepting a stop are not always the same thing. A trader may place the stop correctly, then watch the position move toward it. Suddenly, the loss feels larger than expected. The mind begins negotiating. Maybe give it a little more room. The market may turn. Just this once. Perhaps the problem didn't begin when the stop was moved. Perhaps the risk was never truly accepted before entry. Then comes the target. What is the trade trying to capture? Where does the opportunity reasonably lead? What is the trader holding for? Without a target, the trader may begin managing profit based on emotion. A small profit feels too small. A large profit creates fear of giving it back. The market moves, and the goal keeps changing with it. Finally, the management method. How will the trader respond if the trade begins working? Will the trade be managed structurally? By candles? By a fixed target? By another predefined method? Again, the exact answer depends on the trader's system. But perhaps the worst time to invent the answer is while watching unrealized profit rapidly change. The trader doesn't need to predict everything the market will do. That is impossible. But the trader can decide how they intend to respond. And that is the difference between planning a trade and simply entering one. Chapter 11. The same decisions feel different after entry. This is why preparation matters so much. Before entry, the trader can look at the stop and think calmly. If the market reaches this level, the trade idea is invalid. After entry, the same level may feel like, I'm about to lose this money. Before entry, the trader can evaluate risk. After entry, the trader may feel fear. Before entry, the trader can identify a target. After entry, greed may begin asking for more. Before entry, the trader can choose a management method. After entry, every pullback may create anxiety. The information may be the same, but the emotional experience is completely different. That's why professional traders try to make important decisions before the position begins influencing them. Not because preparation removes emotion, but because preparation gives the trader something to return to when emotion appears. The plan becomes a reference point. The trader doesn't have to ask, what do I feel like doing now? The trader can ask, what did the process already decide? That is a much easier question to answer under pressure. Chapter 12. The Random Trade Test. Perhaps traders need a simple test before entering, not a complicated checklist, not 20 questions, just a moment of clarity. The market begins moving. The trader feels the urge to enter, pause, then ask, have I actually planned this trade? Can the trader clearly identify the setup? Can the trader explain why this entry location makes sense? Is the stop already defined? Has the risk been accepted? Is there a target? Is the management method clear? If the answer is no, perhaps the trader is not looking at a trade yet. Perhaps the trader is looking at an opportunity, and opportunities are everywhere. But not every opportunity is a planned trade. The trader doesn't have to enter simply because the market is moving. The trader doesn't have to participate simply because something looks interesting. And the trader doesn't have to turn every observation into a position. Seeing an opportunity is the beginning of the decision process, not the end. Chapter 13. Restart the process. This becomes even more important after a trade has already been taken. The first trade ends. Win or loss? The position is closed. The decision cycle is complete. Now, pause. Not because another trade is forbidden, but because another trade requires another decision. The trader resets, returns to neutral, then starts from the beginning. What is the setup? Where is the entry? Where is the stop? Is the risk acceptable? Where is the target? How will the trade be managed? If those questions haven't been answered, the process hasn't restarted. And if the process hasn't restarted, perhaps the trader shouldn't either. Trade 2 does not automatically follow Trade 1. Trade 2 must independently earn execution. The same is true for Trade 3, Trade 4, Trade 5. The number of trades isn't the principle. The quality of the preparation is. Every new position deserves a new decision process. Every trade deserves a fresh decision maker. Chapter 14. From random trading to complete decisions. Many traders try to stop random trading by creating stricter rules. Only 2 trades. No revenge trading. Don't overtrade. Those rules may be useful, but sometimes the trader still finds a way around them because the deeper habit hasn't changed. The trader still sees movement and enters before thinking. Perhaps the goal isn't only to take fewer trades. Perhaps the goal is to practice making complete decisions. A complete decision has a beginning. The opportunity is recognized. The setup is identified. The trade is planned. The risk is accepted. The position is executed. The trade is managed. The trade ends. Then, the decision cycle closes. If another opportunity appears, a new cycle begins. This is very different from random trading. Random trading often has no clear beginning and no clear ending. One trade flows into another. The trader carries excitement forward, or frustration, or urgency. The chart keeps moving. The trader keeps responding. Eventually, the trader may not even remember why each position was opened. There were many entries, but very few complete decisions. Perhaps this is why fewer, well-executed trades can be so valuable for traders who are learning discipline or building a reliable process. Not because one trade is the correct number for everyone, but because complete decisions are easier to study, easier to repeat, easier to improve. A trader can look back and ask, did the setup qualify? Was the entry correct? Was the risk accepted? Was the stop respected? Was the management executed as planned? Was the trade completed? That's how a process becomes clearer. That's how execution becomes more consistent. And perhaps that's how random entries slowly begin to disappear. Final thoughts. Random trades can begin for many different reasons. Fear of missing out, revenge, excitement, boredom, the desire to make more money, the desire to feel productive, or perhaps the market simply starts moving and something looks good. The reason may be different for every trader, but before the entry, there is often a moment, a small space, a chance to pause. The trader can click, or the trader can ask one question. Have I actually planned this trade? What is the setup? Why this entry? Where is the stop? Is the risk truly accepted? What is the target? How will the trade be managed? If those decisions don't exist yet, perhaps the trader doesn't need to enter yet, because an entry is not a trade plan. And after one trade ends, the same principle begins again. The previous win does not plan the next trade. The previous loss does not plan the next trade. The market's momentum does not plan the next trade. The trader does. Pause, reset, return to the process. If another high-quality setup exists, plan it. Define it. Accept the risk. Decide how it will be managed. Then execute. But don't let one trade quietly carry the trader into another. Don't let a position begin before the decision process is complete, because every trade, whether it is the first trade of the day or the fifth, deserves a fresh decision, a complete plan, and a trader who knows exactly what they are trying to do. Seeing an opportunity is not the same as preparing a trade. An entry is not a trade plan, and every trade must independently earn execution. If this video resonated with you, I'd love to hear your thoughts in the comments. Have you ever entered a trade simply because it looked good in the moment, only to realize afterward that you never really had a complete trade plan? I'd love to hear your experience. If you know another trader who might benefit from this video, consider sharing it with them. And if you'd like more videos about trading psychology, professional decision-making, and becoming the trader you want to become, consider subscribing. Because trading is not only a journey of learning the markets, it's also a journey of learning how to make better decisions before money is at risk.